Good morning. My name is Rainer Nonnengässer. I'm in real estate business now for some 25 years. The last 10 years I have dedicated to student accommodation, micro-living, co-living, whatever name tag you might want to put on it. And recently I've joined International Campus, beginning of this year as CEO for the group. And we are a German-based company. For sure, Germany is our core target market in our evolution of the last years. But we are currently also active in Austria, in Hungary, in Czech Republic, in the Netherlands, in Poland, and we are also currently considering expanding our range into Italy and Spain. Our core is student. But in the light of the evolution of the product over the last years, we are starting more and more looking into young professionals, co-living schemes, as we clearly see that these borderline between those different sub-asset classes are ceasing to exist. And I'm pretty sure that in the next years also the borderline between hospitality products, resi products, or concept-based living products will see more and more loopholes, so things are more or less merging.
Okay, great. Luke.
Hi, good morning. My name is Luke Dawson, and I'm the Regional Managing Director for Colliers across Central Europe, and then I also head up our capital markets teams across Central Europe, including Poland. You were all able to find your way here today, so I'm guessing I don't have to introduce Colliers. But in terms of the markets we serve in Central Europe, obviously Poland, Czech Republic, Hungary, Bulgaria, Romania, Slovakia. So all the countries that Derek was talking about earlier today are what we cover off from a capital markets perspective. So I'm sure we'll touch on it more today, but it's been an interesting one, and things are definitely changing for good and bad in both cases. So we'll touch on that today.
Great. Anna.
My name is Anna Duchnowska, and I have the pleasure to head Invesco Real Estate in Poland. We are an institutional investment manager quoted on the New York Stock Exchange, so we are pretty big, one of the top probably 20 investors globally, or investment managers rather. We're active here in Poland for more than 20 years, although the office has been set up 5 years ago. We have a portfolio around 1.2 billion euro, investing mainly in offices, or actually all commercial classes of assets. Recently, main focus has been on logistics, but obviously we're looking also at other sectors such as resi and student housing as well.
Okay, good. Janusz.
Hi, I'm Janusz Dzianachowski. I'm a real estate partner at Linklaters here in Warsaw. Linklaters is a global law firm. We are basically present in most of the big cities across the globe. We have real estate and teams across the continent, most of the capital cities. In Warsaw, we have a team of 20 plus real estate lawyers focusing mainly on investment work. So what we do, we typically work with investors when they come to Poland, when they want to buy, when they want to sell, when they exit, when they do JVs and this kind of work. So that's what we do. I've been with Links for the last 15 years roughly. So that's quite some time now. So thank you.
Okay, good. Janusz, let's start with you. Just in terms of, we obviously did the poll at the beginning in terms of the risks that people were seeing, and that was also then highlighted in Darish's presentation. For the clients that are coming to you, and particularly looking at the region, how are they judging the risks, whether it's political risks? What are they saying to you?
I think it largely depends what clients we're talking about, because some clients will have different appetite for risk, and obviously some clients will be interested what's going on with the judicial reform and the things that we had on press for quite some time. But I think that lots of this discussion we already had, like 2 years ago, year and a half ago, and now I think that honestly we haven't had that many discussions about these political risks. It's more, I think, in the context of Brexit, how Brexit will impact the markets here, but it's not necessarily in terms of risks, but more how we can benefit from that. So the other way around. That's my impression. I think that if you are looking for investors like South Africans, for example, which are a big group of investors, they are responsible for a sizable volume. Their political risks down in the ground are far different, and I think far greater than what we're having here. So that's again, it's quite individual thing, but we don't have those discussions that many actually as one could expect.
Okay, good. I mean, that's interesting to pick up the point about seeing Brexit as an advantage. Difficult for me to look at from my base in London. But Anna, looking at the risks, how do you assess those? And I suppose things like Brexit, has that changed any of the strategy, I suppose, from Invesco head office towards Poland CEE? Has it had any actual impact so far?
I mean, obviously there is a lot of discussion about how Brexit will impact the real estate market. So far, when you're looking at the valuations and general perception of the UK market, there has not been so much, like, so negative appetite. I mean, we're still investing there, mainly in resi. Our recent residential fund for UK, which has been fundraised over the last 2 years, have been very successful. So we are active there. Maybe a little bit less in terms of retail. More at the moment, more investors are looking at the continental Europe generally. Versus investing in Great Britain. There is a kind of a wait-and-see strategy for a moment, but we are very active in other markets like France or Germany. Obviously, we are looking at CEE countries. However, it's very difficult to buy something. I mean, we've been bidding last week for 2 assets in Czech Republic, in Prague, and we just lost. Simply, there are a queue of investors, actually domestic investors, who are much more aggressive in terms of pricing. They understand the market better and they can bid more. So we remain very active in the logistics sector at the moment. In Poland, we have completed 5 deals over the last 18 months, and we still continue to invest in the logistics sector at the moment.
Okay, good. It's interesting to pick up that point about domestic investors beginning to compete much more, and I'll pick that up in a minute. Rainer, just coming to you, because there's a number of questions. Thank you for those coming in on Slido. One of which is about, just in general, some initial investors' feedback re-Brexit. Is it having any influence on you, what you're hearing in the market? Obviously, you may not be active there in the same way, but what sense are you getting, I suppose, from your colleagues in the German real estate industry?
I think there are a lot of different aspects to be taken into consideration. If you talk to guys in Frankfurt, they have a strong view that the Frankfurt market, be it the office market, be it the resi market, will strongly benefit from a Brexit. In other areas where you have more macro focus, I think it's more described by the uncertainty that come along with the Brexit and the effects on the economy and the uncertainty going along with that. So I don't see a pure view on the real estate side in Germany on Brexit in assessing the consequences out of it so far.
Okay, good. And Luke, obviously you're head of capital markets for the whole of the CEE region. Is there an expectation from Prague, from Warsaw, from various, that there may be some form of benefit, whether that's in the office sector, serviced office sector, logistics, where that is from some of these political risk elements that are coming up?
Yeah, I mean, it's hard to quantify exactly how much it would be or where, but I do think that anytime you see instability in Western Europe, when it comes to, say, political risk, it first of all makes us look better. But on the other side of it, the capital at some point, say particularly with Brexit, certain pockets of capital may say, you know what, we're going to hold off on the UK for now until we see what happens. But they still have capital to deploy. So that capital naturally is going to find a home. Part of it will probably go to Western Europe. But as our markets continue to mature, markets like Poland are kind of filling that gap of it's somewhere between Western Europe and it's somewhere between an emerging market. So people are feeling more comfort with the risk side of things, but the returns are also at a level where it's pretty attractive. So all in all, I think Brexit from an investment standpoint is a benefit to Central Europe. Is it going to change our investment volumes by €1 billion? Probably not. But will we maybe see a few investors come and look that otherwise wouldn't have? Yes, I think so.
Okay, good. Let's just pick up on some of the other risks that came up. I mean, Darius there mentioned that actually the levels of high employment were creating difficulty, and certainly that's come through in other discussions we've had on pan-European logistics, especially that actually finding the staff is more of an issue than actually finding the asset in a way. Anybody can pick up on that if they like, but is that a big issue, or how do you see that in comparison to other issues?
I think it's a bit of a double-edged sword, and I'd argue that it's a positive. I mean, I think there's a lot in the press because it's a nice story that there's so low unemployment and wages are increasing that it's affecting the industries in terms of manufacturing. And to an extent it is, but you're still seeing companies like BMW and auto manufacturers setting up in Hungary, which is probably the worst case study in Central Europe for increasing wages, but yet they still see the value in Central Europe. So I think you look at it from the perspective of consumer spending, where these people that are increasing their wages have more money in their pocket, which leads to more retail spending, which drives GDP, which are all actually kind of the backbone of the story of Central Europe. So I like to take it as a positive. Yes, if I've got a factory in a secondary city in the Czech Republic, I'm probably not enjoying my HR challenges right now. But from a broader standpoint, I actually think it's a positive, and it just tends to be a nice negative hook in the media.
Okay, good. I just wanted to pick up with you, Rainer, obviously, because you're active in the region. Is this any of an issue in terms of getting staffing? And also, I've got a question come in, which I'll deal with now, which is in terms of growth of particularly international students, foreign students coming into Poland. Is that part of the basis for your kind of growth plans in Poland? What's your view on that?
Let me start with the latter. I think there are various aspects that you need to take into consideration. One is the European Bologna process of harmonizing higher education structures, which was initiated a few years ago, has led to the situation that you now can compare study structures in various European countries with each other, and they are now way easier to get accepted cross-border. That's one thing which drives higher education in Europe. The other thing is that this framework has more or less boosted the Erasmus figures, which means student exchange within Europe over the last years. And if you look at how, let's say, the Erasmus destinations have changed or evolved over the last years, you can definitely see a trend that cities like Budapest, Prague, and Warsaw have gained much more attraction over the last years for various reasons. A, these are attractive cities. B, they are young and lively. C, the cost of living is presumably lower than in other European cities. Same effects you have in Lisbon, for example. And then comes a situation that demand and supply are completely imbalanced. So if you come from Spain or Sweden or the Netherlands and go to Budapest and looking for accommodation, you really have a hard time. It's pretty much the same all over these major cities in CEE. And altogether, these are the factors, for sure, also underpinned by macroeconomic views on how is the economy evolving, how is the political system evolving. All these factors together describe the attractiveness for us to invest in one of these countries.
And just picking up on that point in terms of attractiveness, from a German perspective, how do you, we mentioned a little bit about Brexit, but you've obviously got in Germany, Merkel leaving the scene. Do you see that as creating an issue in Germany? There was a mention there in Darius's presentation about potential economic effects of that. Do you see that? And also, just how do you see political risk in terms of CEE? Obviously, you're quite active, but are things like what's happening in Hungary, those kinds of things which have been going on for a long period of time, do they concern you as a German investor?
The deferred death of Angela Merkel on a political point of view is definitely not a positive factor to the German setup currently. And there are also some other aspects who have an impact on the economy, be it the car industry, the diesel discussion, whatever you take. This for sure will have an impact on the way Germany will be willing and able to deal with other issues of other European countries in the next months and years, having domestic problems to be solved. From our perspective, when it comes to the student accommodation sector, over the last decades, phases of, let's say, weaker economy have always proven that higher education is an investment in the future. And therefore, student numbers have been quite resistant to economic changes. And from that end, I don't think that we will see parallel movements in shorter time frames between economic development in the various countries to student figures and deriving from the student figures the demand for accommodation of the students. So in a nutshell, I'm still positive on the sector in CEE and in other European countries, because the same question you could raise on Italy, which is to me the even more a question mark than Brexit as the effect on the EU. And Spain is recovering, but it's in its early stage of recovery. So there are still a lot of uncertainties in the whole European area, which could significantly impact the economic situation pretty quickly.
Okay, good. I mean, it's quite interesting as well when we're in, you know, if we were doing things in June in Paris when we did the outlook there, everybody massively positive about Macron and the position of France then within Europe. Then fast forward to December of this year, just after the Gilets jaunes had started, I think it was the first weekend before the event that they'd been on the streets. And then the panel was split at that point saying, well, I think this may be, you know, there'll be maybe next weekend and then that'll be it. To another voice on the panel who was saying, well, actually, no, I think this is a serious issue for France. And you can see how quickly sometimes these risks appear in different countries as well. I want to touch a bit more on some of the sectors. Just give me some insights, if you can, Anna, on how you're seeing, let's say, the office markets particularly and growth in that and logistics. Opportunities for rental growth were mentioned in the presentation. How do you see that? Let's look at those two particular topics.
I'm very confident about office generally. And what Luke was just saying about the pressure on wages, I just wanted to point out that actually the pressure on wages in CEE is nothing different than the pressure on wages which is happening in Germany or in France, because in nominal terms these are probably higher pressures. And if you add on top of that the unions and the strikes and the issues with the labor market generally, CEE does look very optimistic. This was, for example, the reason why Amazon decided at some stage to move their logistics location on the cross-border on the Polish side rather than dealing with the unions in Germany. That was the beginning, and suddenly they expanded. And became probably one of the largest employer in several regions across German border. But talking about office, I think the pressure on wages and generally increasing the construction costs will definitely push the rental growth, especially in the cities like Warsaw, maybe Kraków and Wrocław, which are established cities. And actually, the rental growth is the most important trigger for the institutional investor to buy into the story. Because obviously we cannot count on the further yield compression, although I was saying the same last year and probably all of us was wrong, so maybe. But I mean, the rental growth will trigger the investments rather than the yield compression, the whole underwriting, the whole... when we as investors are analyzing the project, we are looking definitely in the rental growth potential. So we definitely will be active in the office sector. The problem in Poland and in Prague as well is the lack of products. Really, if there are good products, there is a queue of investors paying some time horrendous pricing for those offices, which is good for the market. One negative thing about Poland is that we don't have any domestic capital, which is a pity. And to look at Czech Republic, how quickly it has changed to the level where almost 50% of the acquisitions are done by the domestic capital. And I really truly believe that it should also happen in Poland, but without changes in the regulations, it will be massive. It will be simply very difficult. In terms of logistics, very positive thing is that Poland became, as a whole, a special economic zone, which makes it easier for the investors' decision to locate their logistic operations in Poland. I'm sure this sector will be growing. Asian investors that Darek was talking about are mainly looking at the long leases into logistics sector. So definitely this is the trend, the build to suit trend will continue. And actually, at the moment we are experiencing a very funny situation where the yields for the logistics are much more aggressive than the yields for retail, which is quite a strange situation, taking into account the history and basically the cycle of the development. So the question is how much more logistic yield will compress. And it depends probably of the number of the investors willing to invest in that sector. So we definitely remain very, very focused on the logistics and on the office in the region, although there are challenges with the product availability. That's why we invest at the level of forward funding in most of our logistics deal to get some spread at the entry to the deal at the early stage.
Okay, good. I'm going to pick up on some of those points, but Janusz, I want to just pick up with you that it's interesting, I think anyway, that capital is available, domestic capital is available in other parts of the CEE, but not really in Poland. And yet there should be domestic capital in Poland, which would change the market hugely just in terms of how that operates. I know when we were doing the CEE summit in November, there was talk then about the REIT regime, and certainly the South African delegation that were there felt that would create quite a big change to the market. Do you see any chance of these things actually coming to fruition? Do you see that pool of domestic capital being able to be in a position at some point in the next 12 months, 24 months, to be able to be competing properly?
Just maybe one comment on what Anna said. I fully agree that I think that the big problem here in Poland is that there is a huge lack of Polish capital. So basically 90-something% of investment volume is being created by foreign investors. And if you compare to Czech Republic, this is a different world. While lots of money is just sitting in the bank accounts, and it should be somehow moved. The good thing is that we've seen over the last 6 months, maybe difficult to catch, lots of new instructions and requests for proposals from Polish entities, like new Polish structures, new Polish fund managements. Obviously, different volume. It's not like big deals for a few €100 million, but they are trying to collect local money and invest it. But it's just difficult to compete with very experienced investment managers like Invesco and anyone else. The problem with this frozen capital here in Poland is that there is no structure to invest. Obviously, we had this discussion about REITs for years now, and nothing really changed. Obviously, the REITs now are being structured to invest in resi mainly, which is probably good for the resi investors. But if you compare the breakdown for the resi investments and all the other commercial real estate asset classes, that's not where currently the interest is. So I think that I'm not sure if anything will happen. I'm going to be pessimist here. So unfortunately, I think that we will be struggling for some time now, unless there will be like a proper big change in the mentality of lawmakers, and they will allow us to create some tools. Because currently there's no legal structure how we can just help people investing their private money. That's as simple as that, I'm afraid.
Okay, good. Well, not so good, in fact. But and we're going to try, so this year, the 2019 CEE Summit, which will be in Warsaw again, there'll be a larger delegation from South Africa, but also we're currently reaching out to Korea as well, so that we can then get some Asian capital coming also to visit the markets and explain a little bit about what they're looking for, which I think will be really interesting. Regional markets, let's look a little bit at locations. Rainer's obviously active in some of the regional markets, particularly here in Poland, and we can come to that in a minute. But Luke, in terms of regional markets versus capital cities, what's your sense of that overall for the region? What types of investors are looking, and are there genuine opportunities for international capital in those regional cities?
I think you've got to isolate Poland because it's clearly a very different setup in terms of population, in terms of history, investment market, etc. when it comes to the regional cities. So Poland, yes, in all accounts, there is and there will continue to be a strong regional market. When you're looking at the other countries in Central Europe, I think it will struggle, to be completely honest. I think the only country that even has a similar setup to Poland, when you look at how the country is established, where you've got larger secondary cities, is Romania. Romania has its own challenges right now, economically and politically, but on the face of it, it's probably the only country where you could say you could see a minor investment market developing in Cluj, Timișoara, etc., off the back of the size of the cities, off the back of the BPO SSE sectors there. So I think Romania, potentially, Czech Republic, I mean, you have Brno, and then you've maybe got Pilsen, but none of them are really business hubs. Brno's the only one that has a tech sector, which arguably you may see some transactions. But really, I think in Central Europe, more and more capital is actually going to be focused, when they're looking at, say, retail and offices, they're going to be focused on the capital cities. And I think that's going to continue as we approach the top of the cycle. So the real answer is, I think Poland's a bit unique. I think Romania's got potential. And then otherwise, I think you will struggle to see a strong, liquid secondary city market in the other countries.
Okay. And Anna, in terms of your investment strategy, logistics obviously enables you really to be able to, by definition, to be able to move away from the capital cities because it needs to be across the region. But is there opportunity also for office in regional markets?
I mean, so far we have not been very successful in the regional cities. We've been looking at a couple of occasions, but unfortunately without success. I mean, the interest, I would say, is quite limited. I mean, for the regional cities, you would need to attract a little bit different type of investors, not super core, but rather core plus, or even value-add investors. And actually, we are now getting more and more inquiries from our separate account clients on the value-add opportunities. And this might be an interesting proposition for the regional cities. For us, for Invesco, it was always about liquidity, and 1 million square meter was kind of a minimum limit requirement for the city to really become or be liquid in eyes of institutional investors. I know some German mandates are very active there, and they have different strategies. However, for us, it's quite difficult to persuade, although I'm a big fan of regional cities, it's quite difficult for me to persuade my investors to go there. So we will be watching the market, but I'm not sure whether we will expand it. It really depends on the client. We actually work with a number of clients in Poland, so it's not just Invesco. There are different institutional money behind, more and more Asian money, looking at logistics. German money still focus on the office sector, but they, for some reason, would like to focus on Warsaw or Prague, basically.
Okay, good. In terms of the capital, Luke, obviously, are you seeing different types of capital, looking at Czech Republic versus Poland versus maybe then some of the more, Budapest, Bucharest? Are you still seeing a range of capital looking at all of those markets, or are you seeing trends emerge?
I think not much has changed year over year, but we have seen more Asian capital, whereas last year people were talking about it in a more broad sense. We're actually seeing transactions taking place. We're seeing more, particularly Korean money, touring into Poland and then moving on to Czech Republic and working its way south. We've seen Philippines investors here in Poland. We've seen other Asian capital active here in Poland. And I think that'll continue. And that's not just a Central European thing. I think it's almost a global thing, but more importantly, European. And the Asian investors are coming here simply because returns in Asia are very, very low. They make us look cheap. And they're also looking to diversify and get money out of Asia at the moment. And I think Central Europe will be one of the homes within Europe, but we're seeing them in London, we're seeing them in Germany, etc. And I think part of our role as agents in the broader market is to pull as much of the capital that we can from Korea, etc., to Central Europe. So I would say Asian money. I think North American money, US money is pulled back. Canadian money, I was there in December, is actually starting to take a closer look at Central Europe. I think they're probably 12 to 18 months out, but they actually have it in their business plans now, which is something we haven't seen before. South Africa money will continue, I'm sure, to invest. I don't see any major shifts. I don't see any new entrants necessarily, but I do think they'll become more of a steady, recurring player in our markets. And then the other factor is just the domestic capital, which we've touched on. But I think what's nice for us is that when you look at the makeup of the capital now, it's wildly different than it was 5 or 6 years ago, and to the better, in the sense that you've got a lot more pockets of capital. It's not just German money, UK money, and a little bit of domestic. We now have kind of 5 or 6 strong pools of funds active in Central Europe. So I think it bodes well as we kind of, as I said, hit the top or near the top of the market, that we have a more stable base than we used to.
Okay, good. I'm going to come back to you in a second, Rainer, with a question that's come in from the audience here. But there's been a couple of ones coming in on retail, and I want to try and synthesize those into one. One of which was about, you mentioned, Darius, obviously, that that London is quite down on retail at the moment, which is true in the session that we had in London, but also actually in Germany and France. Everybody was slightly down on retail, but more so in the UK, and that was also true. EPRA did an outlook in London 2 weeks ago that I was at, and there was also a kind of relatively negative view on retail, although not all aspects of retail. So the majority of people there were thinking that there would be, certainly for the UK market, that if you'd got a good centre, it would do well, and if it was not a great centre, it would not do well. But it'd be interesting just to get the perspectives of anybody here in terms of retail in the CEE. Do you think that it's going to go the way the US markets have gone, which is obviously the big fear in London, or do we think that there's a different market here in CEE, and particularly in Poland?
I mean, generally, the perception of retail is not great in Europe. This is partially driven by the benchmark analysis. Basically, institutional investors are benchmarking themselves how much retail exposure, how much sector exposure they should have. And definitely the retail sector exposure right now is going substantially down in return to like logistics. Logistics is gaining up in the scale. So if you have the pan-European fund like IRIF, our biggest fund, which is looking at those kind of benchmark, and the benchmark suddenly dropped from 38% to 22 or 25. There is a huge pressure from investors basically to sell off certain retail assets, which not necessarily have the basic fundamentals. I remember I was talking to Derek in 2010. The least required class of retail assets were retail parks. Nobody wanted to buy. Suddenly today, the most liquid retail assets in continental Europe are apparently retail parks. So convenience center located very close to the residential area, which is a nature of the changing habits and changing consumer behaviors. I don't think in Poland or in Czech Republic there is oversupply of retail as such, and obviously Poland has this specific that we don't have the high street retailing. But definitely the gap between the best performing shopping centers versus anything else will be growing, and certain investors will have problems with basically I think more the valuation issues rather than really sometimes the fundamentals of the retail. I mean, obviously, omni-channel and the internet has massive impact towards retail, but I'm sure that the retail investors will focus on reconfiguration of those shopping centers in such a way to basically offer an attractive proposition to the consumer. The problem is that it requires time. The omni-channel has been growing very fast, where repositioning of retail takes 2, 3, sometimes 5 years. And it will come. I'm great believer in retail. It will not disappear. Suddenly, people will not be buying only on the internet. They will be more convenience-oriented. They want quick deliveries, fast deliveries, more offer, more selection. So if you talk to the retailers, they are investing in, interactive changing rooms. So when you're trying the clothes, you can press the button and order a new size and to be delivered to your changing room. So there are a lot of investment also on the retailer's side in order to create this proposition. So I think it's just a cycle.
No, it's interesting. I mean, so we're launching in April for the ICSC one called a new magazine called Living Retail, specifically looking at trends, but also placing it within that idea of that it's part of life, because that's, I think, is an interesting, and also the idea of more mixed use, because there seems to in general be a change towards mixed use where you've got shopping, you've got office, you've got bars, you've got leisure facilities, food offerings, all in the same area, and that it's actually about living in a sense, not about going in and buying something. Sorry, Luke.
Just anecdotally to pick up on what Anna was saying, I was in the US in December, and I went into Banana Republic. And now what they do is when you are at the till, they say, would you like to take this home now, or would you like us to deliver it? And one of their options, which people were doing, which was they would go there, they would buy things, and they'd walk out of the store without a bag. And the goods would show up at their house later that day or the next day, which for me was a big change, because you realize that, and people were still buying, this is maybe one of the avenues where it will go, is that consumers, as long as they can kind of get it within a reasonable amount of time, are absolutely fine to have it shipped to their house and go on to the next store without any bags. So it's those things you're seeing on the high streets in the US that are a big change. The other thing was that I think the story of US malls shuttering their doors and shutting down is overblown. It's been the stores that have the big Sears department stores as the anchor that have been in the most trouble. And that's older 30, 40-year-old shopping centers, which we don't have in Poland and the Czech Republic. So I think you have to look at the product on its own, rather than just painting retail with the same brush everywhere.
And one of the things that actually was picked up in the London one as well is that although regional shopping malls are probably a bit of an issue in the UK at the moment, that actually you've got retail parks are a very big success story. So you've got different ways of shopping, and it's interesting to pick up on that point about home deliveries, because it's one of the things that constantly comes up. Whereas, not that I remember it, but I remember things being delivered to my house because people didn't have a car when I was growing up. It wasn't that common to have your own car in the same way, and or certainly in the very poor village I was in. That before that, obviously, in 1905 or 1895, if you were wealthy enough and you went to Selfridges, it would of course be delivered. I mean, or your servant would pick it up. You would never take your shopping with you. I mean, how absurd. It was always being delivered by somebody on a bicycle, very possibly, but there's no way you would possibly have taken your shopping with you. I mean, that would just be ridiculous. Just quickly on some of the bigger trends, what are we seeing in terms of office and WeWork and those kinds of things? Massive in London. How big of a trend is that here in general? And then I'll come to you on a particular topic, Rainer. In general, how is that sort of shared office, serviced office here in CEE?
I mean, we have massive debate internally about WeWork and co-working options. They are the biggest employer right now, as I understand, in London, taking the largest space. In Warsaw, there are a lot of co-working occupiers also signing huge deals for, 10 or 15,000 square meters. To me, it is very similar to retail. So basically, if a co-working opens the location, it has to be profitable. If the location is not profitable, they simply will shut it down and forget about that. So we have to be quite careful in understanding whether the co-working location in any of the office building we're buying can be profitable. If such a co-working facility is 5, 10, maybe 15% of the total GLA of the building, it's actually a plus. For example, we have an experience with Q22, one of the towers, office towers in Warsaw, where we have such a co-working operator, which is not more than 10%. And they are like 100% occupied, because a lot of startup wants to have the address at Q22, and it works. However, if you have the co-working operation for 50 or 70% of the building, or sometimes 100% of the buildings, then it becomes an issue, because you need to analyze their business model, treat it a bit like a hotel operations or a retail operations, to understand whether it will be profitable. So there is a lot of debate. We remain very cautious about entering in something where co-working has a huge majority of the GLA.
Okay, good. Ryan, a quick question for you that's come up, which is, given the cost of student accommodation, is your product really mainly for international students or also for domestic students?
In all territories where we are active, we are looking at the median of the market. So the answer is clearly not only for internationals. And for sure, if I look all over Europe and look at the split between land price and construction price, which primarily triggers then finally the rent level that I need to achieve, because we're not a non-profit organization, we see various trends, and CEE, like Spain, is more on the lower end when it comes to construction costs. Land prices in the overall trends are picking up everywhere. But in countries like Poland or in Spain or also in Budapest or Prague, we have a much wider opportunity to address a wider audience than, for example, currently in Germany. But by strategy, we are looking at domestic students in the same way as on internationals.
Okay, good. I'm going to fly through a few questions that we've got here, just to make sure we answer them all. In terms of investment product, should we expect more assets to have longer leases in the future, 10 years or more, like in Western Europe, the UK? Any views on that? Longer leases?
I don't think so. From the tenant's perspective.
Okay, sure.
Everybody wants flexibility. Everybody wants, expansion, contraction options. So in the sector of offices, I think we need to adopt our minds to the fact that the tenants will want to have break options or different flexibilities. So the era of, look at UK. There are no longer leases for 20, 25 years.
No, and in fact, interestingly, the question was almost the reverse in the UK, which was, should we have shorter leases in order to fit in with the increased co-working and the demand from tenants? So that's interesting, that. Luke, did you want to pick that up?
Yeah, I would agree completely. The only exception would be owner-occupier, kind of on your more industrial logistics space. We're seeing going for sale and lease backs where they're willing to sign 10, 15, 20-year leases and capitalize on their own lease and the rent payments.
Okay, good. This one's for you, Anna, actually, which is, do you think that the big institutional investors who like retail will focus massively on retail parks in Poland? So what's your view on retail parks?
I'm far from saying that. I think at the moment there is a trend, wait and see, simply. The changes in the omni-channel, in the logistic development, in the internet sector are so quick that the retail is not able to respond with the right repositioning, basically. So when I'm saying that the more liquid products are simply smaller products, retail parks, 3,000-5,000 square meters close to the residential areas, it is easier to sell them, to buy them, to transact. With the shopping centers, it's obviously massive investment volumes, and you need to be very careful as investor to simply understand the product proposition, the location, and the really the catchment areas. I'm laughing whenever I'm reading the catchment areas analysis, like, half an hour drive is all your catchment. It's actually not. It's your very basic primary catchment that you should focus no, I think retail will come back, but at the moment the perception of the market and the cycle trend is quite negative. But it doesn't necessarily mean that suddenly we should sell off our retail investments with a discount.
Okay, and in terms of the cycle, are we beyond the peak per sector? Do we expect yields to tighten, flatten, or widen? Quite a big question, that one, actually. In fairness. How do we see, where do you think we are in the cycle at the moment?
To paraphrase Mark Robinson, who just released a report from Colliers today, I would say we're getting close to the plateau. I don't want to call it a peak because I don't think it's reminiscent of kind of 2007, 2008. My view is that we're getting actually to a nice place to be, where I'm hoping there's going to be stability for the next, say, 2 or 3 years. I think we saw it on the poll we did at the beginning that people are actually looking at investment volumes to remain flat. And I would like that to be the case. I think if we saw another major jump in 2019, that actually wouldn't necessarily be good for the market if you're looking at it mid to long term. So I would say we're almost more at a plateau in terms of where we're at in the market. In terms of the various sectors, I think offices will probably see the most positive story this year. Industrial logistics is continuing to be positive, so I'm almost discounting that in that I don't see a major change one way or the other, but I think that offices will be more active. I think retail, frankly, will continue to struggle in pockets, particularly outside of Poland. And I don't see a lot of assets coming up for sale on the retail side anyway. So as a whole, I'm happy with where Central Europe is at. I think we're in a good place. Assuming that everything on a macro level holds where we are, then we've got another good year or two at least ahead of us.
Okay, good. A couple of quick questions for you, Janusz, which is, in terms of, we spoke a little bit here about, I suppose, livability, those kinds of aspects. I did an interview with Perty van Harnen, who's global CEO of Aberdeen Standard. he was saying that one of the big trends he was seeing was ESG, particularly in the demand for capital in terms of that aspect of it, but also living, anything around living. So that includes student housing, includes senior living, includes healthcare, those kinds of things. Are you seeing that in terms of the overall trends? And also, are there any particular either legal or tax things that people should be aware of, should have on their calendar for 2019 as an area of concern or an area where they might have an advantage?
Well, maybe responding by coming back a little bit to what Luke just said, I think that in this year, and that we expect this to be kind of more as a trend, is that this, what we say, alternative asset classes, so student housing, resi, especially resi for rent, hotels, will be growing. That's something which is still a little tiny and has a huge potential. And we've actually seen a lot of this happening, like in a preparatory phase last year. And things will be actually coming to the market, or there are transactions actually at the moment on large hotel deals, large resi platforms, etc. So I think this will be growing definitely. Obviously, if you look at Poland, it's probably limited mainly to hotels, student housing, and resi. I don't think senior housing and this kind of things we're not probably ready yet. And also, it only works well when it has some state help, state subsidies, and in Poland it's not yet the case. Like, there are some student houses close to German borders, mainly for German pensioners, but they're actually having some funding from the German state, so that makes a good match. But in Poland, not necessarily. I don't think there's anything specifically legal about that. That's just a commercial real estate. And obviously, there are structures, there are ways to do deals about resi and about hotels, and that's nothing new. Taxation is always a bit of a pain, and structuring this, which especially these days with this MDR thing and reporting by anyone about anything which is tax driven, may be a bit tricky. And I think everyone is still considering how we will be tackling this. But that's mainly an internal issue for the advisors, I guess.
Okay, good. We've come up to the end of our time. So is there any questions that anybody's got or any thoughts that they want to give?
So Janusz, actually, about the due diligence process, because you touched on it briefly about structures, but the process itself seems to be very long and convoluted in Poland when compared to Western markets. Are there any changes there that we can expect to improve that process and maybe speed it up a bit to get to get the market closer to Western European markets?
Yes, and I think that most of the law firms, I'm not sure how about that may relate to other advisors, but definitely law firms are working on that. Due diligence was always a pain. That's the most painful process, and it takes a long time to go through all the leases and this stuff. And we're trying to limit this. We're trying to kind of push some materiality threshold, materiality benchmark, but also we are working on some AI solutions like software which is helping us to do due diligence. So we don't spend like 2 or 3 months reading the leases for the shopping center, but rather have the software or computer helping us to map the document. And we're now implementing this. It looks like we will be able to save like 30 to 40% of associates' time on due diligence. So that's I think a way to go forward. But I think everyone realizes that we need to be more efficient on due diligence.
Okay, good. Any other questions? Yes, go ahead.
To what extent will you see the strongly increased project cost to put a brake on new development in commercial real estate, particularly office?
Yeah, I think construction costs are going to be one of the big drivers for the next few years. When you look at, first of all, wage growth, when you look at the cost of supplies, etc. Across the region, construction costs for kind of CBD office buildings are increasing anywhere from 10 to 17%. So you'll see probably 2 things happen. One, some developers hold back on developments. And then you'll also see developers try and pass the cost on to the tenants ultimately in the form of rents. which will drive probably some rental growth in theory if occupiers are willing to pay it. So it is a big question. I think that you're going to see this come up more and more, which isn't great because it may halt some development, but on the other hand, it could keep our markets, as I said, more on the plateau than us continuing to have a development boom and then we're oversupplied. So it's not ideal, but on the other hand, it might not be a bad thing for us.
I've got a final quick one that we always ask of these, which is about investment. So one quick question to each of you, which is, what do you see as the biggest trend influencing real estate this year? And also, where do you think people should invest their hard-earned money? Let's start with you, Janusz. Biggest trend, and where should people invest? You can either, I know that you're a lawyer, so there's a disclaimer attached.
Thank you. The biggest trend, maybe from a lawyer's perspective, I think the biggest trend on the legal end of things, and that's actually, I think, something that Angus would like to hear, is that the deals are now being done much quicker and much more efficient. So I think that given the competition on the market, given that there is always a line of investors bidding for the same asset, I think that the process needs to be done very, very efficiently and very quickly. So I'm not responding to whether this is logistic, retail, or office, or anything else, but generally, I think the speed and efficiency of transacting, that's something which we will be looking at. The deals will be much quicker. And if you're asking me where I would be investing, probably still logistics.
Okay, good. Anna?
Definitely the trend is logistics and e-commerce, omnichannel, anything related to the internet and the way how it impacts the way we live, the way we work, the way we communicate, or the way we do our shopping. So that's definitely a trend, and I think the investment in the logistic will be even increasing definitely. The question is by what percentage. And the other trend, which I'm very pleased, is that we have finally a pool of diversified investors from the different various countries or from different regions. That finally not only German investors do feel confident about investing in Poland, but actually South Africans or more Asian investors right now feel that the macroeconomic fundamentals and the way Poland has developed is something interesting, and they want to focus on. Recently, before Christmas, I had a visit of one of the largest Japanese bank, who was visiting, like vice president, who was visiting different countries in Europe, and they picked up Poland. They picked up Warsaw as a location where they are looking at the potential opportunities for real estate investment, which is a very good information for our market.
Okay, good. Luke?
I think one interesting trend that we're seeing is that sellers are being more selective around who the buyer is. So they're not necessarily chasing the best price, they're chasing the most reliable buyer. And I think that they've realized that they can't chase necessarily whoever's going to pay the most. They want to find out who's going to actually close on a deal. So we're seeing more capital chasing each deal, which means that they can afford to maybe give up a little bit of money to make sure that they're going to close the deal. So I think that's a change that we've seen. In terms of where I'd put my money, it would be with this fellow beside me in student housing. I think that that's going to be a sector, it's still in its infancy in Central Europe, but is a long-term sustainable asset class that's got a lot of runway in terms of development.
And as an investor, if you've got children who are going to be coming in, you obviously give free places to your investors as well.
Sure.
So thank you.